Over the past several days, an unusual pattern has been forming beneath the surface of the silver market. Not in the way price ticks are typically discussed, and not in the daily volatility most participants have learned to ignore, but in the relationship between where silver is being priced and where it is actually being exchanged. Most sessions pass without consequence. This one drew attention because it reflected a shift in behavior rather than sentiment. Based on publicly available pricing at the time of observation, silver and Western benchmark markets continued to trade within ranges that would not, on their own, suggest disorder. Spot prices reflected a continuation of an upward trend already underway, consistent with broader precious metal strength. At the same time, reported transaction prices tied to physical delivery in parts of Asia were notably higher. The difference itself was not unprecedented. What made it analytically relevant was the size of the gap and the speed at which it appeared. Price differentials between regions occur regularly. Transportation costs, taxes, timing mismatches, and local demand can all create temporary spreads. In most cases, those spreads are narrow enough that they close quickly through routine arbitrage. When they widen beyond normal bounds, the adjustment mechanism changes. Instead of paper flows rebalancing prices, physical movement begins to matter more. At the time these figures were observed, Western spot prices for silver were just under $90 per ounce. In contrast, reported prices associated with physical settlement in Shanghai implied levels above $100. Framed conservatively, this represented a double-digit dollar differential per ounce before accounting for logistics. The precise number fluctuated, but the direction was consistent. Physical metal was commanding a materially higher price in the East than in the West. It is important to be careful here. A higher quoted price in one market does not automatically imply stress or malfunction in another. Regional exchanges operate under different rules, currencies, and settlement structures. However, when a persistent premium appears on the physical side, it raises questions about how supply is being allocated and how quickly inventories can respond. One way to think about this is to separate price discovery from price fulfillment. Futures markets, by design, facilitate price discovery. Physical markets, particularly those tied closely to industrial consumption or long-term storage, are more directly about fulfillment. When both align, the system functions smoothly. When they diverge, the system begins to reveal friction. At the same time this regional price gap was forming, gold was trading in a relatively orderly upward channel. Its movement was measured, incremental, and consistent with patterns seen during other periods of macro uncertainty. Silver, by contrast, was moving faster. Based on the available data at that moment, silver's percentage gains over short intervals were multiple times those of gold. That relative acceleration is not, by itself, evidence of instability. Historically, silver often amplifies gold's moves during precious metal cycles. The relationship between the two metals is commonly expressed through the gold to silver ratio, which measures how many ounces of silver are required to equal 1 ounce of gold. Over long periods, that ratio has fluctuated within wide bands. When it rises, silver is relatively inexpensive compared with gold. When it falls, silver is relatively expensive. At the time in question, the ratio was near the lower end of its recent range and trending downward, reflecting silver's stronger performance. Ratios, however, are descriptive rather than predictive. They summarize relationships that exist. They do not explain why those relationships are changing. To understand the mechanics, it is necessary to look at how arbitrage functions when physical delivery is involved. Arbitrage, in its simplest form, is the act of buying an asset in one market and selling it in another to capture a price difference. When the asset is digital or purely financial, this process is nearly instantaneous. When the asset is physical metal, arbitrage involves storage, insurance, transport, and time. Because of these frictions, physical arbitrage only becomes attractive when the price differential exceeds a certain threshold. If the spread between two markets is small, it is not worth the effort. If the spread widens sufficiently, participants with access to logistics and inventory begin to act. They source metal where it is cheaper and deliver it where it is more expensive. This process continues until the spread narrows or inventories are depleted. Publicly reported vault data from Western exchanges had already shown gradual declines in registered silver inventories prior to this episode. Inventory drawdowns alone do not imply distress. They can reflect seasonal patterns, financing decisions, or changes in storage preference. However, when drawdowns accelerate at the same time, regional physical premiums widen, the coincidence warrants attention. There are alternative explanations that must be considered. One is that the higher Asian prices reflect localized demand spikes tied to seasonal factors or regulatory adjustments. Another is that currency effects or reporting conventions exaggerate the apparent premium. A third is that the spread is temporary and will close as Western prices adjust upward or Eastern demand cools. Each of these explanations has precedent. Similar gaps have appeared in other commodities and resolved without lasting impact. The analytical challenge is determining whether current conditions resemble those transient episodes or whether they indicate a deeper supply allocation issue. Industrial demand is often cited as a moderating force in silver markets. High prices, the argument goes, reduce consumption in sectors like electronics and solar manufacturing, eventually easing pressure. That dynamic is real over longer horizons. In the short term, however, industrial users typically operate under fixed production schedules and contractual obligations. Their ability to reduce consumption quickly is limited, which can make short-term demand relatively inelastic. At the same time, investment demand behaves differently. When price differences suggest scarcity in one region and abundance in another, capital tends to move toward the perceived imbalance. This does not require coordinated intent or speculative fervor. It follows from incentives embedded in pricing. Another factor often raised is the role of futures markets and short positions. Futures contracts can increase apparent supply by allowing sellers to commit metal for future delivery. This mechanism works smoothly when most contracts are settled financially rather than physically. When more participants seek delivery, the link between paper commitments and physical availability becomes more visible. None of this implies wrongdoing or failure. Futures markets are designed to manage risk, not to warehouse unlimited physical supply. Tension arises only when expectations about delivery diverge from the practical limits of inventory. Historically, exchanges have responded to periods of heightened volatility through adjustments such as margin requirement changes. These measures are intended to reduce leverage and dampen rapid price movements. They have, at times, coincided with sharp short-term reversals. Whether such actions would meaningfully affect a physical arbitrage dynamic depends on whether the underlying incentive, the regional price gap, remains. From an analytical standpoint, the key variables to monitor are straightforward. One is whether Western prices begin to converge toward higher physical prices observed elsewhere, narrowing the spread. Another is whether reported inventory levels stabilize, suggesting that metal flows are slowing. A third is the behavior of gold, which often acts as a stabilizing reference point within the precious metals complex. If gold were to reverse sharply, silver's relative strength would likely diminish as well. Conversely, if gold maintains its broader trend, silver's volatility may continue to express itself through ratio compression rather than outright divergence. These are conditional observations, not forecasts. What makes the current situation notable is not a single price print or headline, but the alignment of several indicators: accelerated silver outperformance, widening regional physical premiums, and ongoing inventory movements. Any one of these in isolation would be insufficient to draw conclusions. Together, they form a pattern that merits close observation. Patterns, however, do not resolve instantly. Markets often oscillate, test assumptions, and produce false signals before a clearer structure emerges. At this stage, the mechanisms at work are still unfolding, and the balance between paper pricing and physical allocation has not yet reached a point where outcomes can be assessed with confidence. The interaction between these forces depends on how participants respond over successive trading sessions, how inventories adjust, and whether the incentives driving physical movement persist as conditions evolve. The first question, when a regional physical premium appears this quickly, is not whether it exists, but what is actually being compared. A quoted spot price in New York reflects a liquid benchmark tied to futures-linked discovery. A reported delivery-linked price in Shanghai reflects a market that may be incorporating taxes, currency conversion, local settlement rules, and, critically, immediate access to metal. If those two numbers diverge, the analytical task is to isolate how much of the gap is structural friction and how much is pure scarcity pricing. Based on available data at the time of observation, the gap was wide enough that even after accounting for typical frictions, transport, insurance, financing, and time, there could still be room for profit for participants capable of moving metal. That does not mean every trader can execute it, or that it is free money in a practical sense. Physical arbitrage is constrained by capacity. Who has inventory, who has access to bonded warehousing, who can clear customs, who can manage counterparty risk, and who can move quickly enough that the spread does not vanish before delivery occurs. But when a differential grows beyond the range that frictions can plausibly explain, it becomes less important whether every actor can exploit it, and more important that some actors can. Even a small number of well-capitalized participants can influence flows if the incentive persists. This is the point where the metal begins to behave less like a chart and more like a supply chain. In most commodity markets, price convergence across regions is achieved through inventory adjustment. If one region is more expensive, material is pulled in. If one region is cheaper, material is pulled out. The balancing mechanism is not a narrative, it is logistics. The problem, for silver specifically, is that the logistics chain is slower than modern financial markets. A futures price can change in milliseconds. A shipment of bars takes days or weeks. When those timescales collide, spreads can overshoot. That overshoot is often the first clue that something else is happening in the background. Not necessarily a crisis, but a change in preferences. Who is willing to hold inventory, where they are willing to store it, and what form they are willing to accept. Silver has multiple forms in practice: exchange-approved bars, smaller bars and coins, industrial-grade material, and inventory that is technically available but functionally committed. A benchmark price does not distinguish between these. A delivery market often does. This is why publicly reported vault categories matter. Western Exchange vault reporting typically separates registered inventory, eligible for delivery, versus eligible inventory, stored in exchange facilities but not committed to delivery. Observers sometimes treat changes in these numbers as definitive signals. They are not. Metal can move between categories without leaving a vault. Owners can reclassify holdings based on financing decisions or delivery intentions. Still, when registered inventories decline persistently during a period of wide physical premiums elsewhere, the direction of the signal becomes harder to ignore. A conservative way to interpret such declines is not that metal is vanishing, but that the marginal ounce available for immediate delivery is shrinking relative to the volume of claims that could, in principle, seek delivery. That distinction matters. Futures markets can operate with high volumes even when delivery supply is modest, because most contracts are not intended for physical settlement. The system is stable as long as expectations remain aligned. Traders trade exposure, industrials and some investors take delivery when needed. Inventory rotates. Stress emerges when expectations shift. A wide physical premium elsewhere can act as a catalyst for that shift. If a participant believes that delivery-linked prices represent the true clearing price, they may prefer physical exposure over cash-settled exposure. The moment that preference becomes widespread, the market's behavior changes, not because anyone is coordinating, but because incentives are aligning. This is also where silver's relationship to gold becomes relevant again. Gold trades as a monetary asset more than an industrial input. Its supply chain is different. Large bars, deep central bank and institutional participation, and often more elastic availability in the form of leasing and swaps. Silver, while also a monetary metal historically, is more sensitive to industrial demand and has a smaller above-ground float relative to the size of the paper market that references it. That combination is one reason silver is prone to sharp moves and sharp reversals. At the time of observation, gold's trend was steady, while silver's short-term move was stronger. In ratio terms, that implies compression, silver catching up to gold. Compression can happen for benign reasons. It can also happen because silver is being repriced due to localized scarcity or supply friction. The key is to look for confirming evidence beyond price: premiums, delivery times, inventory drawdowns, and cross-market spreads. At the same time, investors react differently depending on what they believe is happening. Some view premium expansion as a transient phenomenon that will normalize as supply chain bottlenecks clear. Others view it as evidence of a deeper imbalance between paper claims and physical stock. The second viewpoint is not automatically correct, but it is influential because it changes what investors are willing to do. If they believe physical scarcity is rising, they may prefer forms of exposure that allow for direct claims on metal rather than purely synthetic exposure. That preference shift can matter because it changes who is willing to sell into rallies and who prefers to hold through volatility. This leads into the issue of large concentrated exposures, which is often discussed in a way that becomes too certain. Public reporting does not cleanly reveal a single institution's total net exposure across all venues and instruments. Derivatives. Notional values do not translate directly into directional positions. Futures category reports aggregate multiple entities. So any specific number attached to one firm should be treated as an estimate with wide error bars. But the analytical point survives even if the exact figure is unknown. If a large short exposure exists anywhere in the system, rapid price increases can create a forced buying dynamic. Forced buying does not require insolvency or scandal. It can be triggered by routine risk management. Margin requirements rise as volatility rises. Collateral demands increase as mark-to-market moves against a position. Internal limits are reached. Counterparties tighten terms. If a bank or large trader is short, these mechanisms can push them to reduce exposure sooner than they would prefer. That reduction is executed through buying, which can push prices further, creating a feedback loop. The counterpoint, and it is important, is that large institutions rarely hold naked exposures without offsets. A short futures exposure might be hedged by long OTC positions, or by physical holdings, or by client flows that net over time. In a stable system, these hedges are effective enough that extreme narratives fail to materialize. That is why the market has repeatedly absorbed dramatic claims over the years without producing the predicted outcomes. An honest analysis must account for that history of false signals. Yet false signals do not mean stress cannot occur. They mean that the market requires specific conditions for stress to become visible. One of those conditions is time compression. Another is broad participation. Another is the presence of regional constraints that prevent arbitrage from resolving spreads. When those conditions occur together, even well-hedged positions can become harder to manage because liquidity itself becomes uneven. In other words, the risk is not only price direction, it is execution risk. Execution risk is where many models fail. Models assume you can buy or sell the required amount near the prevailing price. In reality, large orders move markets, especially when liquidity providers widen spreads due to volatility. A position that looks manageable on paper can become difficult to unwind quickly without moving price against yourself. That does not guarantee an extreme price event, but it does mean that during stress, markets often overshoot before stabilizing. This is also where the paper versus physical framing becomes useful if handled carefully. The issue is not morality or fraud, it is convertibility under constraint. A futures contract is a standardized promise with options. You can offset, you can roll, or you can take delivery under specified rules. Physical metal is immediate possession. When the market is confident that convertibility is smooth, paper and physical converge. When convertibility is questioned, the market assigns different values to immediacy and certainty. The difference expresses itself as premiums, delivery incentives, and widening spreads between venues. If those premiums widen enough, they can draw metal away from exchange inventories, not because the exchange is failing, but because owners respond to price signals. If metal can be sold at a higher effective price in one region, holders will attempt to route supply there, subject to logistics and policy. That routing reduces the buffer elsewhere. A reduced buffer increases sensitivity to delivery demand. Increased sensitivity raises the likelihood that more participants attempt delivery earlier. The cycle is not inevitable, but it is mechanically plausible, and the key is that these cycles often start quietly. They are not announced. They are inferred from small shifts, a persistent premium that does not close, a faster than normal pace of withdrawals, an unusual pattern of open interest into notice periods, a widening of spreads that normally remain tight. Individually, each shift can have mundane explanations. Together, they can suggest that the market is beginning to price scarcity in time and location, not just scarcity in aggregate. And once scarcity is being priced in those dimensions, the next question becomes how quickly the system can attract enough voluntary selling to rebuild buffers without relying on forced behavior from participants who are trying to reduce exposure under the same tightening conditions that are driving the volatility in the first place. Which is why the most revealing signals are often not the headline price, but the way the near-dated structure behaves as first notice approaches, and the incentives for delivery begin to change in real time as inventories, spreads, and collateral terms all shift in response to the same set of pressures, making the market increasingly dependent on how participants respond once those pressures persist rather than fade. At that stage, the focus naturally shifts away from headline narratives and toward the less visible mechanisms that determine whether stress dissipates or compounds. One of those mechanisms is time. Commodity markets are unusually sensitive to timing because production responds slowly while financial positioning can change rapidly. Even if total above-ground silver stocks are large in absolute terms, only a portion is mobile on short notice. The rest is embedded in industrial processes, long-term holdings, or geographic locations, where moving it is neither quick nor economical. When short-term obligations grow faster than short-term mobility, the market resolves the imbalance through price, but also through delay, substitution, and renegotiation. Delay is often the first pressure valve. Delivery incentives can be offered to encourage rolling positions forward. Cash premiums can be paid to persuade longs not to take metal immediately. These tools are not signs of failure. They are standard features of futures markets. However, they are not infinite. The higher the incentive required to delay, the more the market is signaling that immediate availability carries unusual value. That signal tends to propagate outward, influencing how non-exchange participants behave. Substitution is another valve, particularly for industrial users. In some applications, silver demand is relatively inelastic in the short term. In others, there is limited flexibility to thrift, redesign, or defer usage. The degree of that flexibility matters because it determines how much demand responds to rising prices versus how much must be met regardless of cost. Available data suggests that a portion of industrial demand can adapt over time, but not instantly. That lag can contribute to temporary tightness, even if long-run balance is achievable. Renegotiation sits between these two extremes. Large bilateral contracts, especially in the over-the-counter market, often include provisions that allow counterparties to settle in cash or restructure exposure if delivery becomes impractical. These arrangements reduce systemic risk, but they also change the distribution of who ends up needing physical metal and who exits with a financial settlement. From the market's perspective, that redistribution can matter because it concentrates physical demand among those participants who cannot substitute or delay. Against this backdrop, regulatory oversight plays a stabilizing role, though not always a predictable one. Regulators are primarily concerned with capital adequacy, liquidity, and orderly markets. If volatility rises sharply, margin requirements can be adjusted to ensure that participants can meet obligations. Such adjustments are designed to reduce leverage, but they can also force position changes that amplify price moves in the short run. The intent is stability. The path there can be uneven. It is also important to recognize that banks and large intermediaries manage exposure dynamically. Positions that appear static in public reports may be actively hedged, rebalanced, or offset internally. Stress in one area can be mitigated by gains elsewhere. This internal flexibility is one reason why dramatic projections so often fail to materialize. The system has multiple layers of absorption before any single pressure point becomes decisive. Still, internal flexibility has limits when volatility is extreme or when liquidity thins across venues simultaneously. Liquidity is not just volume, it is the willingness of counterparties to quote prices for size. In periods of uncertainty, that willingness declines. Bid-ask spreads widen, and markets become more sensitive to order flow. Under those conditions, even routine risk reduction can have outsized price impact. Not because supply has vanished, but because willingness to intermediate has temporarily receded. This is where the distinction between clearing price and marginal price becomes relevant. The clearing price reflects where transactions occur at a given moment. The marginal price reflects what it would take to induce additional supply or demand beyond what is already being offered. In calm markets, the two are close. In stressed markets, they diverge. Observed prices may move rapidly toward the marginal level as participants test where resistance lies. However, marginal pricing is not static. As prices rise, behavior changes. Holders who were previously indifferent may decide that selling becomes attractive. Investors who were convinced of scarcity may reassess. Industrial users may find ways to defer consumption. These responses are the market's way of searching for balance. The speed and smoothness of that search determine whether price movements stabilize or overshoot. This brings the analysis back to probabilities rather than certainties. There are plausible paths where current tightness indicators ease without dramatic consequences. New supply could be mobilized faster than expected. Demand growth could slow. Financial positions could be reduced gradually rather than abruptly. In those scenarios, price volatility might remain elevated, but the system would adjust through familiar channels. There are also plausible paths where adjustment is less orderly. If several pressure points align, tight near-term availability, persistent regional premiums, elevated delivery interest, and heightened volatility, then the market may rely more heavily on price to ration access. That does not require any single actor to be overwhelmed. It requires only that incentives shift faster than physical flows can respond. Importantly, none of these paths imply a permanent state. Commodity markets are cyclical. High prices encourage exploration, investment, and efficiency. Over time, supply responds and demand adapts. The question under examination is not where silver will ultimately settle, but how the transition from one balance to another unfolds, and whether that transition is smooth or punctuated by episodes of stress. From an analytical standpoint, the most useful approach is to observe how the market prices time and certainty. Are near-dated contracts commanding unusual premiums relative to longer maturities? Are regional spreads narrowing or widening? Are inventories declining steadily or stabilizing? Are delivery incentives increasing or fading? These signals often change before narratives do. Equally important is maintaining skepticism toward one-sided interpretations. History is full of moments where convincing stories were built on selective data. The discipline lies in continuously updating the assessment as new information arrives, rather than anchoring to a single scenario. Markets tend to punish rigidity more than they reward conviction. As current conditions evolve, the interaction between financial positioning, physical logistics, and regulatory responses will continue to shape price behavior. None of these elements operates in isolation, and none offers a definitive signal on its own. What matters is how they reinforce or offset each other over time, particularly as delivery windows approach and the cost of immediacy becomes clearer in spreads and premiums, which is where the market's real conversation is taking place. Often quietly, often incrementally, and often in ways that only become obvious after the fact. As participants adjust to the shifting balance between claims on silver and the metal that is actually available to meet them under prevailing conditions, leaving the outcome dependent not on a single breaking point, but on the cumulative effect of these mechanisms continuing to interact, as they have been.